US stocks rise, but wariness remains around tech valuations. ANZ Research updates its RBA call, with rates expected to stay at 3.6%. And Australian Q3 GDP out today is set to be buoyed by public sector demand. That's coming up in our 5 Things in 5 Minutes on Wednesday, December the 3rd. And then in our deep dive interview, ANZ Head of Australian Economics, Boyton, explains why the RBA is at the end of its rate cut cycle and what's needed before the next move.
The next direction in interest rates will be given to us by the next exogenous shock.
But first, in 5 and 5 with ANZ, US stocks traded slightly higher overnight, although caution around large tech stock valuations remains. In Europe, annual inflation increased slightly to 2.2% in November. Meanwhile, in Australia today, the focus is on third quarter GDP data, with the final partial indicators in yesterday. ANZ senior economist Adelaide Timbrell is expecting quarterly growth of 0.6%.
So what's driving that? Pretty strong public demand growth, particularly on the investment side. Pretty modest household consumption growth. We think that only grew 0.4%. A little detraction from trade, where we seem to have imported more than we exported. So that's going to take away about 0.1 percentage points. And then a subtraction from inventories as well. So all of that comes together, real mixed bag of data, but still pushing us to what we consider to be a relatively solid growth outcome of 0.6.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.1% and the Nasdaq up 0.3%. The US 10-year Treasury yield was down half a basis point at 4.093%. West Texas oil futures down 0.8% at $58.85 US a barrel. Gold down 1.3% at $4,218 US dollars an ounce. The US dollar index was up 0.1%. The Aussie dollar rose 0.2% to 65.59 US cents, and the Kiwi was up 0.1% at 57.29 US cents. Number 2. Adelaide says that growth would come as the RBA appears to be downgrading its expectations of potential GDP, the level of growth that is sustainable without causing changes in the labour market or prices.
0.6 is going to be likely in line with what they consider to be around or even a little bit potentially above that potential GDP growth. And that's going to likely keep them on the path of not cutting the cash rate from here. So our current RBA call is that the cash rate will stay at 3.6% for an extended period because of where inflation risks are as well as activity risks. And a 0.6 GDP growth is not an emergency signal that we need to increase growth in the economy.
Number 3. As Adelaide mentions there, ANZ Research has updated its RBA rates call to a hold at 3.6% from here. A key reason is a recent jump in inflation. That fed through to higher inflation expectations in last week's ANZ Roy Morgan Consumer Confidence Survey, says ANZ economist Sophia Angala.
Notably, weekly inflation expectations did rise to their highest level in almost 2 years, and that's now sitting at a higher level, just above the pre-COVID level. So far this year, the weekly inflation expectations measure has trended up and is now sitting slightly above the pre-COVID 5-year average.
Number 4. There are early signs Australia's housing market momentum may be easing, says ANZ economist Maddie Dunk. Data yesterday showed building approvals fell 6.4% in October, although that followed an 11.1% rise in September.
When you net it all out, if we look over the last 3 or so months, building approvals have eased a little bit. I would say they've really been steady for most of this year. So we have seen a stalling in that uptrend that it was occurring later last year. And I think for building approvals, there's a few things going on that are making it quite challenging. Feasibility is a huge issue for a lot of builders and developers. Costs have gone up significantly. While we are seeing that housing prices have lifted, they haven't lifted enough to ease some of those feasibility constraints.
Number 5. House prices in the capital cities of Australia still rose by what Maddie says was a pretty solid 1% in November, down only slightly on October's growth.
There's some early signs that maybe we're seeing a bit of easing in the housing market in Australia. If you look at auction clearance rates, they've been trending lower since September, around the time when we had that monthly CPI print that came in stronger than expected and started to, I guess, spark a conversation around potential risks of reacceleration of inflation here in Australia, and then subsequently talk about whether the easing cycle has come to an end.
Maddie Dunk there. Now, in our deep dive interview, ANZ Head of Australian Economics, Boyton, explains why the RBA now looks set to keep the cash rate on hold at 3.6% well into next year.
It's a few things that really come together. Firstly, there's a bit of a sign of inflation pressure persisting in that October monthly. I don't think ultimately, if we have this conversation in 6 months' time, we're in a world where inflation is sustainably outside the RBA's target band, but it's more those signs could well just temper the board's enthusiasm for additional rate cuts. At the same time, over the course of the past week, we've gotten more and more of the partial indicators that help inform our judgment about today's GDP print, and it looks like we're going to get a solid GDP print, which if I took the last couple of quarters for GDP together, you'd say that growth in the economy is running around potential. In our assessment, the labour market's balanced and the cash rate's pretty close to neutral. And so in the absence of being confident that you're going to get some really good inflation numbers over the next little while that give the board the confidence to ease in the first half of next year, the question then becomes, okay, if easing gets pushed into the second half of next year, what does the second half of next year look like? You've got a small tax cut arriving on the 1st of July. You've got some mixed signals across leading indicators of activity, but our broader economic forecasts expect that growth will remain at or a little bit above potential, and with the unemployment rate broadly tracking sideways. So it more just looks like that window then for easing in the second half of next year closes, but it's difficult to see a strong sign either way for which direction the next move in rates ultimately is.
And we've had that recent inflation bump. What are you seeing on the labour market side of things, or what would the RBA be looking at on the labour market side of things, and how would that fit in to this call?
Well, the forward indicators of the labour market that I tend to look at are giving me some conflicting signals. The ANZ Indeed job advertisement series has been a little softer over the past 6 or so months. Consumers' unemployment expectations have risen, but at the same time, you've had quite a solid and reasonable uptrend in businesses' forward orders. And so you have this sort of mixed picture across leading indicators. And I think what that tells you, the fact that everything isn't pointing one way, tells you that we're probably going to bounce around with growth around this circa 2.25, i.e. around what's now the new long-run average, rather than growth being definitively weaker, in which case you could confidently say that interest rates had to be lower, or alternatively growth definitively higher, that was going to give you a lower unemployment rate, higher wages pressure. And actually, the wages one's an interesting one. Wages at an aggregate level going sideways, but more strength in the public than the private sector. So I do wonder if maybe underneath the surface there's a little bit more softness in the labour market than the Reserve Bank's characterisation that the labour market is still a little tight. I would say it's balanced.
So yeah, I guess rates on hold for a while. Obviously, discussion will turn to when the next move might be and why. What's your thinking around that?
Well, this is a really unusual cycle, and this is a particularly really unusual ending of an easing cycle. Typically, when an easing cycle ends, the cash rate is unambiguously stimulatory. This is different. The cash rate has ended at a broadly neutral level. The labour market is broadly in balance. The economy is growing around trend, not demonstrably above, not demonstrably below. And so what that means is actually the next direction in interest rates will be given to us by the next exogenous shock. And it might be a global shock that sees higher inflation and causes the RBA to need to tighten rates sometime in the second half of next year. It could also be that a softer global economy through the course of next year, a little bit more caution from the household sector as they see no more interest rate reductions, ultimately gets you slightly softer growth in the back half of next year and rates end up lower.
Adam Boyton there. And we'll have Kuhn go on the 2026 prospects for Asian currencies tomorrow. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, December the 3rd. Catch you tomorrow with analysis of Australia's third quarter growth data out later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.